This is the solution to the 2019 higher level 100 mark cash flow statement question. As you can see here, you are given the balance sheet of Jackson plc at the end of 2017 and at the end of 2018. Underneath those balance sheets, you're given some additional information, and then down the bottom of the question you are asked to prepare an abridged profit and loss account to ascertain the operating profit for 2018. And you're also asked to prepare a cash flow statement for 2018, including reconciliation statements. So we're going to start by preparing an abridged profit and loss account. An abridged profit and loss account essentially is the bottom part of the profit and loss account. It's the part from operating profit down to the profit and loss balance at the end of the year. So what you should do first is put your heading in and then recreate the bottom part of the P&L by putting in the headings that normally appear there. So you'll start with operating profit, then you'll add on any investment income, then you'll take away any interest on loans. That will give you profit before tax. You take away your tax to get your profit after tax, then you deduct your dividends to give you your retained profit or loss. You add on the profit and loss balance at the 1st of January, and that will give you your profit and loss balance carried forward at the end of the year. So now we aim to get the figures that we can put into the abridged profit and loss account, and I would normally work from the bottom up. I've put the letters ITD in here just to remind ourselves that the order in which the deductions happen are interest gets deducted first, then tax, then dividends. So let's try to find the figures that we need to put into the profit and loss account. First of all, what's the profit and loss balance at the end of the year? Well, this can be found in the finance by section of the balance sheet. There it is there at the end of 2018, €35,600. Then we go looking for the profit and loss balance at the beginning of 2018, which is the same as the P&L balance at the end of 2017. In this case, €42,250. If you had an opening profit and loss balance of €42,250 and a closing profit and loss balance of €35,600, you must have made a loss during the year. The loss will be the difference between those two figures, in this case €6,650. Before you arrived at your loss, you would have taken away your dividends, so now we need to calculate what they are. If we look down the bottom of the question here to this additional information, we will find some information that we need in order to calculate the dividend. So in adjustment 4, you'll see that the total dividend paid for the year was 6 cents per share. Now there were 510,000 shares in this company issued during 2018, so the dividend is going to be 6 cents multiplied by 510,000. So moving back up to the abridged profit and loss account, we'll have a look at what that figure is. So in this case, that'll be 30,600. So now we move back up through the abridged profit and loss account and we try to figure out what our profit after tax is. Well, if we take our profit after tax and deduct our dividends, that gives us our profit or loss. So when we're working backwards, we're going to take our loss, which is minus 6,650, and add on the dividends, which is 30,600, and that'll bring us back up here to our profit after tax. Now we need to figure out what our tax is. So again, we look at the information and see if we can arrive at that figure. In adjustment 5, it tells us that the taxation charged on the profits for the year was 51,000. So that's this year's tax charge, in other words. So we put that in there. So the tax figure would have been taken away from the profit before tax. So in order to go from profit after tax to profit before tax, we take 23,950 and we add 51,000, working our way backwards. That gives you 74,950. Now we need to figure out what our interest deduction was. So the interest will have been charged on our loans. So you can see the information on the loans here in the finance by section. We have a debenture for 120,000 and the rate of interest is 8%. But we notice that our debenture has increased by 40,000 from last year. So we just need to have a look at when that happened. So we're told in adjustment 3 that the debentures, extra debentures of 40,000 were issued on the 30th of the 9th, 2018. So what that means is that extra 40,000 was only issued at the end of September. So essentially, for the first 9 months of the year, you just have your €80,000 debenture, and then for the last 3 months of the year, you have the €120,000 debenture. Now that's relevant when it comes to working out the interest. So we'll have a look here at the interest calculation. So you take 80,000, multiply it by 8%, and you multiply that by 9/12 because you had an €80,000 debenture for 9 months. And then you take 120,000 at 8% and multiply by 3/12 because you only had that loan for 3 months. And if you add those two answers together, that'll give you your interest charge for the year, which is €7,200. So now the profit just before the interest would have been taken away would have been €82,150. You're adding as you move back up through the P&L. Now you need to figure out your investment income. So you know you have quoted investments of €40,000. So let's look here and see is there any information in relation to the amount of interest that you received. We're told in Adjustment 6 that the quoted investments yielded a fixed return of 6%. So the rate of interest earned will be 6% of our investment, which is 40,000. So you can see that in the bracket there. So 6% of 40,000 gives you 2,400. So your operating profit plus your interest would have given you that figure there. So to work backwards, you take 82,150 and you subtract 2,400, giving you an operating profit figure of €79,750. So that's the abridged profit and loss account prepared, and as you can see, you now know what your operating profit figure was for 2018. The next thing we need to do is take that operating profit figure and try to work out what cash came in from operations over the last year. In other words, we need to figure out the cash flow from operating activities. So we start with the operating profit figure and we make adjustments for non-cash items. So the heading here is Reconciliation of Operating Profit to Net Cash Flow from Operating Activities. And we start with the operating profit figure, carried down from above. Now we need to adjust that figure for any non-profit or non-cash items. Normally at higher level, the types of adjustments you're going to have to make here are an adjustment for depreciation, an adjustment for the profit or loss on the sale of a fixed asset, an adjustment for the amortization of goodwill, an adjustment for any increase or decrease in the provision for bad debts. On top of that, you make the usual adjustments for movements in stock, movements in debtors, and movements in creditors. So we'll have a look at those ones first because they're sometimes easier to identify. So if you look here at the balance sheet, you will notice that your stock has increased during the year. An increase in stock represents a cash outflow. So in this case, it's a cash outflow of €18,500. Looking at your debtors, they have decreased during the year by €2,000. If there's a decrease in your debtors, that's a cash inflow. How about your creditors? Well, your creditors here have decreased. Again, it's from one year to the other. So in this case, they've decreased by 8,000. If your creditors have reduced, that's the equivalent of a cash outflow. Now we need to deal with the less obvious ones. Items like depreciation, profit and loss on the sale of a fixed asset, and these other ones here as well. So we'll have a look at depreciation next. Now you can see that you have tangible fixed assets up here in your balance sheet, and then you need to read the notes just to see whether or not anything has happened during the year to those assets. You're told that fixed assets which had cost you $70,000 and on which total depreciation of $27,000 had been provided were sold for $41,300. When you are told that some of your assets have been disposed of, it's always wise to recreate the double entry accounts for those assets so that you can see everything that's been going on. So that's what I'm going to do over on the right hand side here. So I'm going to recreate the double entry accounts for my assets, for my depreciation, and then I'll deal with the disposal as well that they mentioned down in the working. So if I put these accounts together, I'll get a full picture of everything that's been going on with your fixed assets over the past year. So when you are recreating the accounts here, you should always put in the opening and closing balances first. So if I look at the fixed assets here, the opening balance was $550,000. That would have gone in on the debit side of the asset account like that. Your closing balance is $650,000. The closing balance would also go on the debit side. But if you had a balance BD on the debit side, you would have had a balance CD corresponding to that on the credit side, $650,000. So there's the opening and closing balances inserted into the fixed asset account. Now we'll have a look at the depreciation account. The opening balance was $80,000, the closing balance $125,000. So let's put those balances in. The opening balance of $80,000 will go on the credit side of the depreciation account. And the closing balance of 125,000 will also go on the credit side. Now, if you have a closing balance BD of 125,000, you must have had a balance CD corresponding with that of 125,000. So now you have all your opening balances in, and you've taken that information from this section of the balance sheet here. The next thing you should do is enter any additional information that you were given. So you were told that your fixed assets, which cost you 70,000, were disposed of. If you disposed of assets which cost you 70,000, the following would have been the entry that would have been made. You would have credited your fixed asset account with 70,000, reducing it by 70,000 to take account of the disposal, and the other side of that entry would have been put into the disposal account, because the disposal account deals with all information to do with the disposal essentially. What else are you told in this adjustment? You're told that that asset which you disposed of had depreciation accumulated on it of €27,000. So now that you're getting rid of that asset, you must get rid of that depreciation out of the depreciation account. So you would have made an entry on the debit side, and the other side of that entry will go into the disposal account on the credit side in this case. So essentially you're removing all traces of that old asset from the accounts. The second step in a disposal involves you accounting for the proceeds that you got for the asset you disposed of. In this case, you sold the asset for $41,300, so they are the proceeds of sale. Normally, you credit the disposal account with the money that you receive for the asset that you're disposing of. And the other place where that will appear is in the bank account on the debit side, because it's money coming in. Now you've entered all of the information in relation to the opening and closing balances and the disposal. We'll just double check here to make sure that we aren't missing anything else. No, so what we need to do now is have a look at these accounts and see whether or not there are any missing pieces in the jigsaw essentially. So if we look at the fixed asset account here, and if we add up the right hand side, the credit side, it adds up to 720,000. Well, if the credit side adds up to 720,000, which is the larger side, then the debit side should also add up to 720,000, but it doesn't. So there must be a missing piece of information in here. The missing figure is the difference between 550,000 and 720,000, 170,000. And what is that missing figure? Well, it's on the debit side of the asset account, which would indicate that it must represent the purchase of an additional asset. So where would the other side of that entry go? It will go into bank. So you'll see it going in on the money outside of bank. Now, that extra 170,000 that we discovered in the fixed asset account was like a missing piece in a jigsaw puzzle. You wouldn't have realised that that had happened unless you had recreated your fixed asset account. The next account we're going to have a closer look at is the provision for depreciation account. If you have a look on the debit side here, which is the larger side, it adds up to 152,000. Therefore, the credit side must also add up to 152,000, but it doesn't. On the credit side, we only at the moment have 80,000. So it looks as if there is a figure missing there, and that figure would have to be 72,000. Now, what might that figure be? Well, because it's appearing on the credit side of the depreciation account, it looks as if it's this year's depreciation charge. So the other side of that entry will go into the P&L account on the debit side, and you see it going in like this at 72,000. Expenses appearing on the debit, income appearing on the credit. The last account we're going to have a closer look at is the disposal account. On the debit side, you've got 70,000, and on the credit side, you've got 68,300. So as you can see, one side is smaller than the other. Now, the difference between the sides here will be the profit or loss on disposal. The difference in this case slots in on the credit side, and it's €1,700. The other side of that, that's half of a double entry. The other side of that double entry goes into the P&L. In this case, it will have to go in on the debit side of the P&L, which leads you to believe that this is a loss on disposal. So this here is one half of a double entry. The other half goes into the P&L. If it appears on the debit side of the P&L, it's a loss. If it appears on the credit side of the P&L, it's income. So now we have a very full picture of everything that's been going on within those accounts. So if we go back to our question for a moment, we want to know what our depreciation charge was for the year. This information you'll find in the P&L account. We've worked it out that it's €72,000. That now needs to be added back on because that would have been deducted in arriving at the operating profit figure, but it wouldn't have represented money going out, so it now needs to be added back on. The second item we need to adjust for here is the loss on disposal. In this case, you see it in here in the P&L, €1,700. The loss on disposal will have to be added back on. Why? Well, the loss on disposal would have been deducted in arriving at that figure, but that loss didn't represent €1,700 cash going out of the business, so you have to adjust for it and add it back on. The next item you need to consider is the amortization of goodwill. In this case, you can see that the goodwill at the end of 2017 is $66,000 and at the end of 2018 it's $55,000. So are we given any additional information here? Well, we're told it's to be amortised or written off over a 6-year period commencing in 2018. So let's have a look here and see. Well, if you're writing it off over 6 years and it was standing at $66,000, you're obviously writing off $11,000 a year. And you can see that that appears to be what's happened here. So if you're writing off $11,000 a year, then that's what you call the amortisation. Now that amortisation would have been deducted again in arriving at your operating profit, but it doesn't represent cash going out, so it needs to be added back on. Another item you need to adjust for here is any increase or decrease in the bad debts provision. If you look at the bad debts provision here at the end of 2017, it was $1,200. At the end of 2018, it's $1,600. That's an increase of $400. So the bad debts provision has increased during the year. Now, an increase in a bad debts provision is treated as an expense when you're arriving at your operating profit, and therefore it would have reduced your operating profit figure here. But it doesn't represent money going out, so you need to add it back on. Now, if you gather together all of those figures, that will give you your cash flow from operating activities. So even though you made a profit of €79,750, the cash coming in from operations was €140,350, which is significantly more. Now you need to cast your net a little bit wider and produce a cash flow statement. The cash flow statement will list not just your cash flow from operations, but all the other cash flows within the organisation. Financial Reporting Standard number 1 specifies that a certain structure needs to be used when you're preparing a cash flow statement, and that structure will follow the order of the headings that you can see highlighted in yellow here. So in order to help us remember those headings, you can use these letters: O, R, T, C, E, M, F. O standing for operating activities. So the first cash flow that you start with is the cash flow from operations. In this case, $140,350. R stands for return on investment and servicing of finance. Return on investment means interest received essentially, and servicing of finance, interest paid. So you're looking for interest received and interest paid. Now you're talking about money out, money in here. Okay, so let's look at interest paid first of all. At the beginning of the year, you had interest due of €2,000. Then you add on to that this year's interest charge, which is €7,200. That's €9,200 worth of interest. But at the end of the year, you see that you're only due $1,400 of interest. So that means that you must have paid, in this case, €7,800 in interest during the year. So you take the amount due at the beginning, you add on this year's interest charge, and then you take away what's still due at the end of the year in order to figure out what you've paid. You do a similar procedure with your interest received. So for interest received, let's have a look at it and see. We're told, first of all, if you have a look here in the balance sheet, that there's investment interest due to you of $1,800 at the beginning of the year. So at the beginning of the year, you're due to receive €1,800. Then this year's investment income amounts to €2,400. So if you add that on, that gives you a significant amount of investment interest. Now at the end of the year, there's only $2,100 investment interest still due to you. So if you start with the amount due at the beginning of the year, add on this year's investment interest, and take away the amount due at the end of the year, that will tell you how much you've received during the year, in this case $2,100. And in the cash flow statement, you're interested in money in, money out. Is that all right? So that's why you're trying to figure out what those figures are. Okay. So you just put those two together, and that will tell you then what the cash flow is from return on investment and servicing of finances, minus 5,700. T stands for taxation. So what tax did you actually pay during this year? Well, you started off with a tax liability of 51,200. Then you had this year's tax charge on top of that, which you find up here, 51,000. And at the end of the year, you're due to pay 55,000. So you start with what you are owing at the beginning of the year, add on this year's charge, and take away what's still due at the end of the year in order to figure out how much tax you've paid. C stands for capital expenditure of financial investment. This is movements in the fixed asset section of the balance sheet. So we're looking at movements up in this area here. Okay. So first of all, if we have a look at our bank account here, it gives us a very good idea of how movements in fixed assets have affected our cash. So remember here when we did our workings earlier on, we discovered that we must have purchased fixed assets amounting to 170,000. So that would have been money going out. So that's the purchase of a fixed asset, which would have caused money to go out. How much going out? 170,000. Did anything else happen with our fixed assets that we need to be aware of? Well, remember, we disposed of fixed assets and we received 41,300 euros for those assets. So that will have to go in here as well, but that will be money coming in. Were there any other movements? Always check your financial fixed assets. There weren't, okay? So that's it. You've accounted for all movements in fixed assets. If you transfer that subtotal out, that's minus 128,700. E comes next, which means equity dividends or ordinary dividends. So what dividends did you pay during the year? Well, you're told up here that the dividend paid was 6 cents per share, and you've already worked that out earlier on, and that's 30,600 euros. So you just slot that in. And that's a negative figure, of course. It's money going out. After you finish your equity dividends heading, you do a subtotal at this stage. A subtotal of all your cash flows so far. So that amounts to minus 71,850. You have two headings left. Management of liquid resources and financing. Management of liquid resources means movements in your government securities. So did you buy them or did you sell them? If we look at the balance sheet here, we can see that we must have purchased government securities, which would have represented a cash outflow, in this case of 27,000 euros. Lastly, financing. You're looking at movements in the finance by section and how that might have affected cash. Your debentures are increasing from 80,000 to 120,000, so that would have been a cash flow of 40,000 coming into the business. Your ordinary share capital went from 450,000 to 510,000, so again, that's a cash flow coming into the business, 60,000. Your share premium has also increased by 12,000. You must have issued some of those shares at a higher price, at a premium, so that would have generated an extra 12,000 euros coming into the business. So your subtotal there is 112,000 positive. Now you take these last three figures and you subtotal them again. And that gives you an increase in cash of 13,150. So essentially you're saying that 13,150 euros came into the business over the last year. And not only that, but you're able to describe exactly where that cash flow came from. So you can describe all the cash inflows and outflows that led you to 13,150 in cash coming into the business over the last year. The last thing we need to do here is have a look at our net debt and how it's moved during the year. Now, before we do this, we need to understand what net debt is. So net debt is borrowings minus liquid resources, essentially. So borrowings mean debentures and bank overdrafts, minus liquid resources, you're talking about cash, bank and government securities. So that's how you calculate your net debt. I usually start with the net debt at the end of the year and at the beginning of the year, and then I'm able to figure out what the change in net debt has been, and then we explain how that change in net debt came about. So I'm just going to work from the bottom up here. So I'm looking for my net debt at the end of 2018. So I'm looking at borrowings first, which is your debentures of 120,000 and your bank overdraft of 15. That's 135,000. From that, I'll be deducting cash, bank and government securities. So I'll be deducting 4,000 and 27,000. So if you take 120,000, add 15 and deduct your 27 and your 4, that will give you your net debt at the end of the year, 104,000. What's the net debt at the beginning of the year? Well, let's have a look at the end of 2017 and see. Your borrowings, first of all, debentures 80,000, bank overdraft 25,000, that's 105,000. From that, you take away your cash, bank and government securities. So in this case, there are no government securities, you're just taking away your cash, 850. So if you do that, you'll arrive at a net debt of 104,150. So at the beginning of 2018, your net debt was 104,150, and at the end of 2018, it's 104,000. So your net debt has actually decreased by €150. So how did that decrease come about? Well, any movements in any of these elements here will cause a movement in the net debt. So what we need to do now is have a look at movements in debentures, bank overdraft, cash, bank and government securities, and take each one of those in turn and have a look at how that would have affected the net debt. So essentially we're explaining this change in net debt that has happened here. So we'll start maybe with movements in debentures. So the debentures have gone from 80,000 to 120,000. That's an increase of 40,000. If there's been an increase in your debentures, that will increase your debt. So that's having a negative effect there, okay? It's creating more debt, essentially. The next thing that we may look at is maybe government securities for a minute. So government securities have gone from nothing to 27,000. Now, because our government securities have increased, that will decrease our net debt. So to decrease a negative figure, you're going to have a positive figure. So it's going to be a positive 27,000. You're decreasing your debt, so you're decreasing a negative figure. Lastly, we need to look at movements in bank overdraft, cash and bank. Movements in these three items are summarised in your increase in cash figure. So the increase in cash figure basically summarises any movements that have been made or happened in bank overdraft, cash or bank. So we can see there's been an increase in cash here of 13,150. So I have that in here like that. Now if your cash has gone up, your net debt has gone down. If your net debt is going down, we'll have to put that in as a positive figure. So now you notice if you put 27,000, 13,150 and minus 40,000 together, that will give you €150. So essentially you've explained why your debt has gone down by €150 by breaking it down as you have up there. And that brings us to the end of the higher level 2019 100 mark question on cash flow statements.